Hello folks, welcome back to another Smart Simple Savings, and today we are talking investing, and I want to talk to you guys about something specific, dividend investing. We're going to walk through even the basics of what is a dividend all the way through to what kind of companies you should be buying and how to evaluate them. So what is a dividend? A dividend is a distribution of a company's earnings that is paid out to its stockholders either on a monthly, quarterly, or yearly basis. And who pays a dividend? These are large established companies that are past their major growth stage, and they've decided to take part of their earnings and pay it back to their investors as an incentive. You're looking at large companies that you know, things like Target, Walmart, Coca-Cola, Starbucks, Lowe's, Apple. All of these big established companies pay out dividends to their shareholders, most of these on a quarterly basis. So why dividend paying companies? For one, these are like I said, the large established companies. They're going to be less volatile in certain volatile markets, especially where we're at right now. If you look in the past month, you've seen the S&P down 11% just in the past month, and it's down over 22% in the past year, or for year to date. And so when you have these companies on top of some of your high growth, they're going to move more in the market, and these are going to be much more stable. So it provides some great diversification in your portfolio. But I love the compounding effect that buying some of these, especially when they're down like the market is right now, and allow them to appreciate their growth again, but also as they're paying, and if you can hold these long term, it creates a great income opportunity. So if you want to know if any company pays a dividend, what you want to do is any website you go to that you're going to look up a stock, or any brokerage site, when you look up that symbol, as you scroll down to some of their details, you should see the word dividend, and it's going to have a percentage, and some may have a dollar amount underneath it if it pays a dividend. And so you're looking for something between like the 1 and 3, 1 and 4%. And what that dividend yield, that's the annual amount that they pay out. And so the way that works is, say you have, we'll say company X, and they pay a 3% dividend. And so say I buy 100 shares of that company at $10 a share, so I have a $1,000 investment, and that company pays 3%, so that's $30 a year. Now they may pay out quarterly, and so if you see that percentage, that's not what you receive quarterly, that's the annualized. So over the year, they're going to pay out 3%. And a way for you to calculate that yourself, you can take that annual dividend dollar amount that they show, and if you divide it by their stock price, that will give you their dividend percentage. Another key metric to look at when you're searching up companies is the dividend payout ratio, and that's the percent of their dividend or percent of their earnings that they're paying out as a dividend. So you want something in the 40 to 50%. You're gonna have to dig a little more into the details, into their dividend statistics to find it, but if there's a company paying out 80 to 90% of their earnings as dividend, if something would happen to that company, or there's a big downturn in the market like we've had, they may have to halt or decrease their dividend. But a company that's in that 40 to 50% is going to be much more sustainable and be able to maintain that dividend payout. All right, with all the different options of dividend paying companies out there, where do you look? And so the first place I go to is looking at the dividend aristocrats and the dividend kings, because those are going to be your most reliable companies. The dividend aristocrats are companies that have paid a dividend or raised their dividend for 25 plus years. They're in the S&P 500, and they have over a $3 billion market cap. So those are going to be your Targets, your Lowe's, your big companies that you know that are very consistent in their dividend payout. The other is the dividend kings, and those are sitting at over 50 years of dividend growth payout. And so all of those are going to be your well-established companies that you heard of, that you shop at, that is a good piece to have in your portfolio. But even just looking at those two categories, and some of those companies overlap, you're still probably going to have more companies in there than that you could buy. So another way to narrow it down is to buy what you know. Warren Buffett has said something very similar to that, is buy where you shop, buy the companies or the products you use. So if you're looking at things like Target, Home Depot, Lowe's, Coca-Cola, Starbucks, Apple, all of these companies, look for the things you use, the things you buy, the places you shop and look into those companies. Those are the companies you know because you're in their stores. You know if they're growing. You know if they're keeping up with all the different trends. So you have the best idea of where that company's going and if that company's growing. And companies like Target, who have raised their dividend for 49 years, Lowe's has raised theirs for consecutively 46 years, and even a company like Johnson & Johnson, with a massive array of product, has raised their dividend for 58 years. So those are just examples of some of the companies to go look for that you know you're going to get consistent growth, consistent payout. And if you're still unsure what to buy, or you don't know, or you don't want to buy individual companies, there are some ETFs, some exchange traded funds that only hold dividends. And so that's a great place to go. If you just want to buy 2 or 3 of those, give yourself some great diversification in portfolio. And those are more of kind of a set it and forget it versus trying to keep track year over year of what's going on with those specific companies you bought. And 2 great ETFs are the Vanguard High Dividend. That's VYM is their ticker symbol. That is full of high dividend, consistent paying. And there's also VIG, which is their Vanguard Dividend Appreciation. So those are companies that are rapidly growing their dividends. So they're probably a little bit younger companies. You're gonna get a little more growth out of those. So you should see some differences between those two. But there's a lot more out there as far as ETFs that specifically track dividend companies. For you to go out there and do some research, pick the one that has a few companies that you like and that you know, and use that as a good metric. And one other final option on dividends to purchase is called a REIT. And I'll do a whole nother video on these. It's called Real Estate Investment Trust. And these REITs, by their name, are ways for you to get into real estate that are going to hold different types of real estate, whether it's, you can look at your shopping malls, medical facilities, some do apartment complexes. There's a wide variety, and again, I'll do another video on it. But what they do is these have a special tax basis where they pay out 90% of their income, their taxable income, to you, and they pay that on a monthly basis. So it's not only a great dividend option, but it's a great way to diversify into real estate without going out and buying a rental property or trying to invest specifically into a property. You can go out and buy these REITs, and it gives you exposure to the real estate market, but also some great dividend options, like I said, that pay every month. Now, when a company pays out the dividend, you have a few options. You can have it paid out just to cash into your account, where you have the option to withdraw that cash, or you have the option to reinvest that cash in a different investment. But you also have what's called a DRIP option, which is a dividend reinvestment program that all brokerages have, and you can set that on some or all of those dividend paying companies, that when it pays the dividend, will automatically reinvest that back into that company. And that's what I recommend doing, especially until you get up to the retirement age, to allow that to compound and grow. And then once you get to where you're going to start drawing on some of those funds, then you can turn that DRIP off and cash, and potentially only live off the dividend payouts. If that's been growing for a long time, you're not actually drawing on the company's stock. But until that point, DRIP is what I would recommend. All right, last thing, you've got your dividend stocks you want to buy, your ETFs you want to buy, but you're not sure which account to put them in. So let's talk through a few of those. I want you to first look at your Roth IRA or Roth 401k, because dividends do have some tax implications. But if you're putting them in a Roth, which is a highly tax advantaged account, you're not going to pay any taxes on those dividends, whether when they're paid or when you draw them out, if it's in a Roth. If it's in a traditional IRA, you're not going to pay taxes on that, and it's taxed at your ordinary income, but not until you withdraw that out of your traditional IRA. Now, if you have it in a regular brokerage account, you're going to be taxed based on your tax bracket every year, and it doesn't matter whether you have that automatically reinvested or it's received in cash. All right, thanks for watching. I hope you guys enjoyed this. If you have any other questions on dividends, please leave a note down in the comments, and I'd happy to do some more research and answer any of those questions for you. Make sure to like, subscribe, hit that notification bell. I hope you guys found this useful, and continue to be smart, simple savers.